Hi there, it's Bill with Smart Trades, and it's Tuesday, November 1st, just before noon Pacific time. And as always, if you'd like more timely updates, please visit smarttrades.com and subscribe to my service. Um, at any rate, we'll get into the S&P here. As some of you may remember, we were looking for a target range actually for some time up in the 1250 to 1285 area, and actually had two specific zones, about 1250 to 1260, and if we got through there, the next target zone was going to be 1285, 1290 basis the cash, a little lower than that on the futures. That 1285 area in particular, I emphasize because that's right where the market started crashing before the S&P downgrade information became public. That's back around the beginning of August. At any rate, we actually had two closes right at 1285, one just a few ticks below and one just a few ticks above 1285. Got to about 1292 intraday, and from there, obviously, we have indeed keeled over. Also of note, we've reached the bottom of the triangle. I have cheated a little bit in this triangle. I've connected the bottom of the triangle to the low close rather than the actual low of the triangle, and in doing so it just about has a perfect hit. Again, here's my long-term count. I've been emphasizing this count for some time. I do have a bit of a problem with the way that this C wave has unfolded, if indeed it is complete. I assume that it is. Today's last couple of days decline is quite impulsive, and I think we've probably put in a top. And again, the way the market respected that 1285 level with two closes within less than a point, I think is quite remarkable. At any rate, here is also, I talked about this some months ago, the possibility that we would retest the neckline of the Head and Shoulders top. And again, I've cheated just a bit here. I've connected the trend line to the low weekly close, and as you can see, we've got almost a direct hit there. We can count this a variety of ways, but again, I'm basically assuming that this is an A down, B up. And in the past, I had also talked about the area around 1285 being important, because if we did get there, it would set up a nearly perfect A equals C for a retest of the area around 1000 basis the S&P. At any rate, we have indeed done that. We'll see if that high holds. I think it's around 1292 and change to be exact. Again, the closes are right at 1285, give or take a point. We are at an important support level. You'll remember the peak in April of 2010. It was just below 1220. We have swing highs right around that level now, and indeed intraday we're testing that level from above. So 1220 support is the first thing that needs to break in order for us, obviously, to get down to the area around S&P 1000. The Dow, very similar scenario, and if we count this as a five-wave structure down either as 1 or A, for now it doesn't matter so much. Long term, obviously it does, but if we have an A down, B back up, and A equals C scenario would target just about 9600 basis the Dow, and that also fits very nicely with the 2010 low around 9600, 9614 to be exact, I believe. Here's the short-term picture on the Dow. Really a messy count in terms of the rally up over the last few weeks, but from the low on the 18th, you can clearly count a five-wave structure up. There's no overlap here. 3 is not the shortest. You have clear impulse waves in the impulsive portions of the structure up, corrective waves on the way down, and obviously an impulse wave off of the top, possibly a wave 3 today at the lows, and wave 4 rally perhaps in progress now. It's also possible to count this as 1, 2, 3, 4, and an extended fifth. If that's the case, we could bounce all the way back to about Dow 12,010, and we shall see. But for now, I'm assuming that this is a third wave down, and that we've got a little lower to go before we bounce. Here's a bigger picture. Here again, there's previous fourth wave support, which so far is holding, although being stretched a bit. The ABC variation of the rally, again, here's the 5 waves of C, no overlap. 3 is not the shortest. Nice impulsive structures in the impulse portions. It works out. It's ugly, but it doesn't break any Elliott wave rules. Now that said, the S&P is different. It does overlap, and I think it probably better counts as a wedge. Bottom line is I am not comfortable with the count off of the lows from early October with this as a C wave, but it fits on the longer term picture, and we have an impulse down from 1285. So for now, let's go with it. What we want to see is a corrective rally that fails to make a new high, fails below 1292, preferably around that 1270 area perhaps, or even lower. And again, the structure of that next rally is key, and also the breadth ratios are important as well. So far, again, holding support at that 1220 area, both a intermediate term swing and also a long-term area of potential support. Gold. This is a chart that I posted in my report. I've actually seen this decline counted as a 5-wave structure down, which puzzles me. It's very clearly A, B, C. I don't see how you can count this as a 5-wave structure. And ideally, if indeed we have A up, A, B, C, B down, and then another 5-wave structure up, ideally we would have tested about 1770. We've fallen short of there. It's not impossible that you can count this as 1, 2, 3, 4, and that we may yet get up there. But I think this better counts as an impulse down. And we've fallen a little bit short of the ideal target up there around 1765, 1770. That said, again, it's possible we may go up there. But I think we're going to see lower prices in gold, assuming that we do not take out that 1770 in the top of this channel in the next several days and weeks. Bonds, I had a target for the bonds around the 112 level, down to about 111. We slightly exceeded that to the downside. Very ugly looking, irregular flat or expanded flat ABC. That said, the general area of 111 has held, and we've got an impulse back up. So potential exists for the bonds to retest their highs. Again, as with stocks, you want to see a corrective decline that holds. That would help confirm the pattern and the probability that this decline was corrective and that we're into an impulsive rally to the upside. One of the keys, I think, for the market is Apple. I think there's a pretty good chance that, at least on a short-term basis, Apple has peaked. You got a 1 down. We're working on a wave 2 back up. About the 412, 413 area is going to be key for Apple. You can see the declining momentum and volume on the rally back up. And it's possible we've already peaked in Apple, but I like it to go up there one more time, perhaps along with our wave 2 for the broader market. And finally, another ugly chart, the euro. I think it probably best counts as an ABC along with the stock market. You can see, again, a very ugly 5-wave structure in C. I suppose this could be counted as a double zigzag, but the bottom line is the impulsiveness of the decline. I can't really count this as a C wave, so I think this best counts as a wave 1 down, and I think that's in sync with the stock market as well. The trouble in Europe, all of that is going to weigh on stocks, I believe, in the coming months. And as with stocks, we want to see a corrective rally that fails to take out the recent highs above 142. And if we get that, that'd probably be a good place to look at the short side of the euro, short side of the stock market as well, assuming, again, we get that corrective rally back up. Anyway, thanks so much for watching. Once again, please visit smarttrades.com if you'd like more frequent updates. I update every day on Twitter, if possible, and do several updates a week via email with more detailed analysis than I can do here, and much more timely analysis. The videos take a while to put out, so there's no way to really comment on the market in real time the way that I can on Twitter and via email. Anyway, once again, thanks for watching. Have a good week. Bye-bye.